Welcome to this in-depth exploration of the value versus growth investing debate, which has been one of the most fundamental discussions in the investing world for decades. Benjamin Graham, the father of value investing, firmly believed in focusing on undervalued stocks with strong fundamentals. While growth investing has often been centered around betting on high-growth companies with speculative futures, in today's video, we'll break down Graham's philosophy of value investing, examine the differences between value and growth investing, and explore why value investing remains a time-tested strategy for long-term success. Why this debate matters: both value and growth investing have their strengths and weaknesses. Some investors swear by the high returns of growth stocks, while others are drawn to the reliability and safety of value investing. Understanding the difference between these two investing styles is crucial in shaping your own investing approach and risk tolerance. It's also important to understand why Benjamin Graham, who mentored Warren Buffett, warned against the dangers of speculative growth stocks and overvalued companies. The fundamentals of value investing. What is value investing? At its core, value investing involves buying stocks that are undervalued by the market, stocks that are trading for less than their intrinsic value. Investors believe that stock prices can sometimes get out of line with a company's true worth, often due to short-term market conditions or negative sentiment. Benjamin Graham defined intrinsic value as the true value of a company, based on its fundamentals like earnings, dividends, and assets. A value investor seeks stocks that are priced below this intrinsic value. Key principles of value investing according to Graham: margin of safety. One of Graham's cornerstone principles is the margin of safety. This means buying stocks at a significant discount to their intrinsic value, so even if your assessment is slightly off, you are still protected from major losses. Fundamental analysis. Graham advocated for thorough fundamental analysis, which includes evaluating financial statements, earnings, debt levels, and growth prospects. He believed that these factors were the key to identifying undervalued stocks. Long-term focus. Value investing is a long-term strategy. It requires patience and the ability to ignore short-term market fluctuations. Graham emphasized that value investors must have a long-term outlook to allow undervalued stocks to reach their true value. Why Graham was critical of speculative growth stocks. Growth stocks are often priced based on future growth expectations, which can be highly speculative. These stocks are bought with the hope that the company will grow exponentially in the future, but this growth is not guaranteed. Graham warned against investing in stocks priced too high based on speculation. While growth stocks may offer quick returns, they come with significant risks because their valuations are often disconnected from reality. Speculative growth investing leads to market bubbles, where stocks become overpriced and eventually crash when the expected growth doesn't materialize. The fundamentals of growth investing. What is growth investing? On the other hand, growth investing focuses on investing in companies that are expected to grow at an above-average rate compared to other companies in the market. Growth investors typically look for companies with high growth potential, even if their current stock prices are expensive. Unlike value investing, growth investing does not focus on a company's current valuation, but rather on its future potential for growth in earnings, revenues, and market share. Growth investors are willing to pay a premium for stocks that have the potential to experience substantial growth in the coming years, regardless of whether the company is currently undervalued. Key characteristics of growth stocks. High growth potential. Growth stocks tend to be in industries with high potential for expansion, such as technology, biotech, and green energy. Higher risk, higher reward. These stocks are usually more volatile and carry higher risk because they are often not profitable or have unpredictable earnings. However, they also offer the possibility of high returns if the company succeeds in its growth objectives. Focus on future earnings. Growth investors are more concerned with future earnings and the potential for rapid expansion rather than the company's current valuation or financial position. The role of speculation in growth. Growth investing often involves a higher degree of speculation, essentially betting on the future potential of companies. While growth investors expect future profits, the stock's current price might not always reflect the realities of the business. Investing in speculative growth stocks can lead to inflated valuations. where stocks are purchased based on hype rather than actual company performance. An example of this is tech bubbles, like the dot-com bubble of the late 1990s, where stocks of companies that weren't even profitable were trading at very high prices simply due to market hype about the future of the internet. Value investing versus growth investing. The key differences: investment philosophy. Value investing. Value investing is based on the belief that the market sometimes misprices companies. The goal is to buy those companies at a discount to their intrinsic value, thus protecting yourself from significant losses. It's about finding hidden gems that are undervalued by the market. Growth investing. Growth investing, in contrast, is based on the belief that companies with high growth potential will outperform the market. These stocks tend to be higher risk as their future success is uncertain. Growth investors look for companies that can provide explosive future returns, even if they're overpriced today. Risk and return. One of the major differences between value and growth investing is the risk-reward profile. Value investing focuses on reducing risk, whereas growth investing is focused on maximizing returns by taking on more risk. In value investing, you protect your downside by purchasing stocks at a discount. In growth investing, you bet on high growth potential, which comes with the risk of overpaying for stocks or missing out on future growth if things don't go as expected. Risk of bubbles in growth investing. Growth investing is more prone to market bubbles because growth stocks can easily become overpriced based on future expectations. These bubbles eventually burst, leading to sharp declines in stock prices. Market conditions. Value investing tends to perform better in bear markets or market corrections when stocks are undervalued. In these market conditions, the margin of safety concept comes into play. As the stocks have room to rise back to their intrinsic value, growth investing thrives in bull markets or during periods of high optimism, when investors are willing to pay a premium for companies with high growth potential. Benjamin Graham's approach to value investing. Graham's investment strategy for value investors. The intelligent investor. Graham's value investing strategy involves a deep dive into a company's financials, including earnings, debt, and dividend history. He also focused on diversification to reduce risk. Graham also introduced the concept of margin of safety, ensuring that the price you pay for an asset provides a cushion if your assessment of the company's value is incorrect. Long-term focus and patience. Graham stressed that value investing is a long-term strategy. Investors need to focus on the intrinsic value of companies and be patient as the market eventually recognizes their worth. The importance of financials in Graham's value investing. Graham taught investors to focus on financial stability, such as the company's balance sheet, earnings history, and cash flow generation. Strong fundamentals are crucial to value investing because they ensure that the company can weather economic downturns. In contrast, growth investing often overlooks these financial metrics in favor of future growth projections, avoiding speculative growth stocks. Graham was critical of speculative growth stocks because they were often priced too high based on unrealistic expectations. He cautioned investors against investing in companies that had no history of earnings or were heavily dependent on future growth projections. Speculative investing often leads to bubbles, where stocks become overvalued and eventually crash when expectations are not met. Case studies. Real-world applications of value versus growth. Case Study 1. Warren Buffett's value investing. Warren Buffett, one of Graham's most famous disciples, built his fortune by following value investing principles. He looked for companies that were undervalued based on their intrinsic value. With a strong competitive advantage and competent management, his investment in Coca-Cola is a classic example of value investing. He bought the stock when it was undervalued, and it paid off with substantial long-term gains. Case Study 2. The dot-com bubble and growth stocks. 20 minutes. The dot-com bubble of the late 1990s is a prime example of growth investing gone wrong. Many companies with no profits and uncertain futures were priced at astronomical levels. Based purely on the hype around the internet, the bubble eventually burst, and many of these companies went bankrupt or saw their stock prices plummet. Case Study 3. The 2008 financial crisis. During the 2008 financial crisis, value investors who focused on companies with strong fundamentals were better positioned to weather the storm compared to growth investors, who were exposed to speculative assets and companies with unstable valuations. The crisis highlighted the importance of value investing and the risks associated with overpaying for growth stocks. Conclusion and final thoughts. The value versus growth debate is timeless, but it's essential to understand that both strategies have their strengths and weaknesses. Value investing focuses on fundamentals, capital preservation, and buying stocks at a discount, while growth investing aims for high returns by betting on future growth potential, but often at a higher risk. Graham's principles of value investing have stood the test of time, and they continue to offer a safer, more reliable approach to long-term wealth creation. Encouragement to apply these principles if you're looking to start investing or refine your approach. Consider adopting value investing principles. Focus on strong fundamentals, margin of safety, and long-term growth, and you'll likely be better positioned for success than chasing speculative growth stocks. Recap of key takeaways. We've covered a lot today about value investing versus growth investing. We discussed Benjamin Graham's principles, why he advocated for value investing, and the risks associated with speculative growth stocks. While growth investing may seem enticing with the potential for high returns, value investing provides a more reliable, time-tested approach that focuses on long-term gains and capital preservation. Whether you lean more towards value investing or are still intrigued by growth stocks, the important thing is to choose a strategy that aligns with your financial goals, risk tolerance, and investment horizon. Remember, understanding the fundamentals of a company and its intrinsic value is key to making informed, strategic decisions. In the long run, investing wisely and sticking to your strategy will likely provide better results than chasing after short-term gains. Call to action: if you found this video valuable, please give it a thumbs up. It really helps the channel grow and lets me know that you're enjoying the content. What are your thoughts on value versus growth investing? Do you have a favorite strategy or a particular investment that aligns with one of these approaches? Drop your thoughts in the comments below. I'd love to hear from you and have a discussion. And if you're new here, don't forget to subscribe and click the notification bell so you don't miss out on future videos where we'll dive deeper into more investing topics, strategies, and tips. In the next video, we'll be exploring how to analyze stocks using fundamental analysis. We'll go over key metrics and how to assess a company's true value, so stay tuned. We'll also be taking a closer look at investment strategies for different market conditions, whether we're in a bull market or bear market. I'll show you how to adjust your approach to maximize returns and manage risks. Thank you so much for watching and for being part of this community. I appreciate your time and commitment to learning more about investing. Keep refining your investment strategy, stay disciplined, and remember that successful investing is all about patience and knowledge. I'll see you in the next video. Take care and happy investing.